day. I'm glad you all are talking to each other. My name is Julie McCurdy, and on behalf of the Financial Engineering Program and the International Association of Financial Engineers, welcome to our first ever Southern California How I Became a Quant panel. So, you can observe a round of applause. This is, when David is our executive director of the International Association of Financial Engineers, when we started planning this in July, I'll tell you, we really had no idea that the stock market would be crashing today. But, that's really not the focus of our panel today. Of course, it's going to be addressed. The main focus is on how I became a quant, because I'm assuming a lot of you want to become financial engineers, right? Anybody out there want to become a financial engineer? Go into finance, work on Wall Street, or work somewhere else near Wall Street? Well, let me just see. We have several distinguished guests in the audience. Let me just, first of all, welcome and thank our panelists and moderator, and you will have a chance to meet them later on. We have Professor Jay Pride here with our Financial Engineering Program right there in the back and teaches our corporate finance classes. We have David Jaffe, the Executive Director of the International Association of Financial Engineers. Very important. We have Claremont Council Member Peter Yao, which he is. And lots of financial engineering students. Raise your hand if you're a financial engineering student at CGU. So great. Welcome. Thank you all. You look great. So if you want to talk to someone about our program, see someone in a suit. How many students are from the undergraduate? We have 5 undergraduate colleges here, and we have Keck Graduate Institutes. So anybody from any of those places? How many of you just came in from some university within a 2-hour drive of here without traffic, like UCLA, San Diego, USC, Cal Poly, Fullerton? We have a lot of people. And poor David has never been to Southern California, and when I said it's going to take about 2 hours from the airport, welcome to Southern California. And I told him it's not always this hot. So, a couple of things. My deepest condolences to all you Angels fans. That was really, really painful last night. If you were watching, bottom of the night, 2 outs, and we lost. Dodgers, go Dodgers. With that, yeah. Woo, okay. So this is very exciting. Welcome. With that, I'd like to introduce David Jaffe, Executive Director of the International Association of Financial Engineers.
You already know who I am. IFE is a nonprofit trade group for quantitative finance and financial engineering. We're based out of New York and started in 1992. A lot of the work we do is really aimed at practitioners. So we have forums throughout the year for people in the field to talk about what's going on. The Fisher Block Memorial Foundation is our educational arm, and that is for students, helping students who are interested in the field and trying to figure out how to get into the field, helping them with that. How I Became a Quant started about 10 years ago in New York. It's expanded to about 10 cities, and so we're happy to be in Southern California for the first time. So a couple words also about the IFE. In addition, a lot of our events that are in New York, some speakers, Myron Scholes, Jim Simons, Andy Lowe, a few other names you probably recognize. They're at a lot of our events. Unfortunately, even if you can't make it to New York, a lot of those events have been recorded and are on our website. It's only for members only, but student membership is $25, so we've kept it pretty low for many, many years. We keep raising the academic and the practitioner level memberships, but we keep the student membership low. The website also has lists of financial engineering programs. Of course, Claremont's on there as well, but all the programs on there, other student resources, and we're working to build that a little bit more. So if you have any questions about the IFE, please find me afterwards, and I'm happy to help you out where I can and tell you. And with that, I'll turn it over to the moderator. Thanks.
It's amazing that tonight with the baseball playoffs, pre-games for basketball, the presidential debate, that we have so many of you here. And so thank you again for your time. Basically, how it's going to work tonight is that we will have our moderator, John Angus, who is the Dean of the School of Mathematical Sciences and also our Math Academic Director for Financial Engineering. Yeah, you're facing me. He will be moderating, and so it's going to go from 5 until about 6, and at 6 o'clock we will stop for student question interaction. And then after that, if you're not running off the presidential debate, we will have a reception that we'd love to have all of you join us and kind of just discuss what's happening, because it's pretty darn exciting out there. So with that, I'd like to turn it over to Professor and Dean John Angus.
Thank you, Lee, and good afternoon, and welcome to our panel discussion on how I became a quant. I have to start with a disclaimer that nothing said here is to be construed as financial advice, okay? Which is fine, since we don't have any money now in view of the last 2 weeks' performance in the market, so no loss there. So the focus, excuse me, of our distinguished panel today is careers in quantitative finance, but nevertheless, questions relating to the current financial crisis will no doubt be raised. But I want to assure everyone here that the markets closed today with a good balance of winners to match the losers. In fact, let me just make a brief market report, courtesy of the web-based Clyde collection. Helium was up, feathers were down, paper was stationary, fluorescent tubing was dim in light trading, knives were up sharply. Cow steered into a bull market. Pencils lost a few points. Hiking equipment was trailing. Elevators rose while escalators continued their slow decline. Light switches were off. Mining equipment hit rock bottom. Diapers remained unchanged. Shipping lines stayed at an even keel. The market for raisins dried up. Coca-Cola fizzled. Caterpillar stock inched up a bit. You gotta get that sun peaked at midday. Balloon prices were inflated. And Scott tissue touched a new bottom. Finally, batteries exploded in an attempt to recharge the market. Okay. Well, let's get started. I'm going to start the discussion with some questions, and then, as Julie said, I'm going to open the floor for questions from the audience. So let me begin by asking each panelist to take 5 minutes or so and introduce yourselves and give us a brief history of how you ended up working on the highly quantitative end of finance. So let's go ahead and start with your, on this one and go right down the line.
5 minutes. Okay. How I became a quant in 5 minutes. Well, I'm probably one of the more... Pardon me?
Your name?
Oh, Muir Davis. My name is Muir Davis. Okay, sorry. I understand. These mics are a little hot, so I'm not sure where to talk. It all began when I was born. You know, thinking back, I think I always put things into numbers, and I think I always liked to work with numbers because it gave me what I perceived at young ages as an exact answer. And I always felt as though I could get that exact answer, and nobody could tell me I was wrong if I had that exact answer. Now, at a mature age, I recognize that exact answer philosophy was quite foolish. But I think, I'm actually in the energy sector, and I work in demand response. So even within the energy sector, I don't really fit. But what I do in the energy sector is I translate people's behavior or use of electricity into value. So essentially, I'm taking the people's behavior and monetizing it. So that's the end of the spectrum I'm on quantitative financial engineering. And so for any of you who think that what you need to do to be a quant is to go trade, well, I've done that. If you need to be buying or selling options, I've done that. You need to be a market maker or speculate on a portfolio that's basically held by the firm or yourself. I've done that. All that kind of got to be boring after a while. So what I did was go into an area that is generally not considered quant in finance, and turn it into that. So I would charge each of you to think broadly, because wherever you go, if you are truly born a quant, you can turn whatever you do into quant.
Okay, I'm Sam Foster. My story begins at birth as well. Okay, so my story begins at birth as well. I was a Caltech undergrad. I majored in engineering and applied science, which is basically mechanical and earthquake engineering. And I love science. I still love science. I love the way the world works. I love putting it into numbers. I love being able to quantify things. But I love the creative side of science and math and how that sort of translates into sort of finance as well. So I decided after I graduated from Tech with an undergrad degree that I would go work and do database software. So I wrote database software for 3 years, and I wrote it for financial companies, banks, and asset managers. It sort of sparked my interest in how people made money, and what were these underlying things that I was coding. It just was very interesting. And then I had the chance of working for a mutual fund, international equity quant fund up in the Bay Area, and a small sector rotation hedge fund sort of on the side. And that's really where I sort of learned how to be a quant in a practical sense. And it was fantastic. I loved it again. I mean, all of these things were just so fantastic. Then I decided, after 2 years of working there, that I needed a graduate degree. And instead of going and getting some more quant-y thing, because I knew that I loved quant stuff, I loved finance, I didn't want that to be the only thing that I could ever do with my life. So I got an MBA from Stanford. Go trees! And I think it was a great decision. I absolutely loved it. I now work for a company called Amco. It's a fund of funds in Irvine. And while working there, I've done everything from structure a CLO for our clients. And my primary quant responsibilities are we invest in a bunch of quant funds. So I get to know the managers of models, how our managers invest our money on behalf of our clients. But it's all fantastic.
Hello. Hi. Oh, it does work. Okay. I'm Ludwig Kincarini. I went undergrad to Berkeley, and I studied economics and statistics. I then went to MIT and got a PhD in economics. Let me move this over here so I can look straight in the middle here. And so naturally, if you go to MIT, you usually get into sort of, you have a quantitative nature. So I didn't want to go into academics, so I went to Wall Street. I wanted to see the real world and get to know it. And I got a job at the time, it was a bad year on Wall Street, but I got a job at this firm, a British equity house named Schroders, and I started working as a fixed income analyst, studying bonds and mortgage-backed securities and things like that. I then left. I went to the Bank for International Settlements, which is in Switzerland, which is sort of the central bank of the central banks, and I worked on the dealing room floor, and so I did a lot of quant stuff there too, managing the portfolio with we actually had we introduced a quantitative portfolio that we managed with quant mechanisms, and then I also did a lot of quant work for the traders, because we had like 100 billion moving through each day with central banks and that sort of stuff. Then I got a call to go help a former SEC commissioner start a company in near Washington, D.C. in Virginia. So I went there and I helped him build this company, which was an internet brokerage company, and it was really a great company. We were in all the best magazines, best of 2008, 2000, all that junk like that. We went down with the internet, though, unfortunately. The company still exists, but instead of billions, it's a little less. Okay. So that was unfortunate. But I used a lot of my quant skills there, and my team was very good. I hired an entire team of all these great quants, so that was really fun. And then, what did I do? I went and worked for a mutual fund house, and we were a quantitative mutual fund operation, although the quant was a little bit exaggerated here, like half quant. And I did that for a while, then I got bored with that, and then I went to teach at Georgetown for a little while, finance, And while I was doing that, I was consulting for hedge funds the whole way through, and I still consult for hedge funds. And then I came to Pomona. So now I'm a professor at Pomona. I still consult for hedge funds and things of that sort. So that's me in a nutshell. I think I answered all the questions.
My name is Steve Safra. I'm a portfolio manager at Analytic Investors right here in downtown LA. I've been in analytics since '99. I started my career as a quant I finished my graduate work in economics at USC in '97, and I went to the Bay Area to work for a firm called Barra. So probably most of you have at least heard the name Barra if you've been in financial engineering. Barra is a firm that basically builds equity and fixed income risk models for portfolio managers so they can ascertain how much risk they're taking when they invest in the stock market or in the bond market or even the derivative market. I was there for 2 years, and Analytic was my client when I was at Barra, and they approached me in '99, and I decided to come back to LA, go to work for them. We were a really small firm back in '99. Pure quant, no fundamental. There's no fundamental people in the audience, and so I started there. It was a very small firm. We had about $1 billion under management at that time. The firm is run by a really smart guy, a guy named Harinder Silva, who's a PhD out of Irvine, and he's a really creative guy. And the firm has grown a lot since then. We're considered pioneers in what you may have heard of as the 1-30-30 strategies. I don't know if any of you have heard of these, but if you want, we can talk a little bit about this today. And so the firm has really taken off over the last several years. We now have about $12 billion under management. So tremendous growth. It's been a really exciting place to work. It's been a great place to develop skills as a quant. About 3 years ago, I decided I needed to finish my PhD, so I actually came back here in 2005 to do my PhD in economics, and so I'm finishing that up right now, writing a dissertation, and right now I'm trying to write a dissertation and deal with this crisis we're in. So it's been interesting, but it's been a great ride, and this time period actually has been particularly good for quants, because a lot of the traditional quant factors, which probably a lot of you have at least read about, have really been in favor for the last 10 years or so. And as a result, not only my firm, but quant firms in general have really taken off over the last 10 years. And I think just the fact that there's a program here and there's FE programs all around the country are a testament to that. So it's a really interesting time to be a quant, and happy to be here.
So we have a very diverse set of panels here representing lots of different companies that employ quants. So let me now ask each of you to describe a typical day or task in your life as a quant at your company. Maybe a good day. And try to speak as though you're trying to attract some of these students to apply to your company. And that, let's start with, can we start with Samantha on this one?
So, I'm trying to think of what I did today. It's just, every day recently has just been such a long day. So a lot of my time is spent sort of bilaterally. A lot is people management and managing our managers. So let me just describe what we do. So we take client money and we invest in 50 to 70 different hedge funds at a time. They're across the spectrum of long-short equity, equity market neutral, quant stuff, credit hedging, distressed debt, merger arb, convertible bond, right? So there's a whole spectrum. And I have 7 managers across those different sector buckets. So half of my day-to-day was spent talking to my managers figuring what they had done in the last week of September, because I talked to them quite frequently, and they all know my voice, and I don't even have to, yeah, they all know who I am. And the other half of my time today was spent wondering if we should buy the equity portion of another CLO that has come to market, Bankland. So it is very different. It's very people oriented, but it's also looking at waterfall diagrams of cash flows from bank loans, estimating the number of defaults, looking at the rates of returns and what the spread is over LIBOR and the funds we're going to get, and trying to build a gigantic model and stuff like that.
So it sounds like there's quite a bit of statistical analysis in your daily work.
There's a lot of people stuff, and there's a lot of math stuff. And I mean, other people at my firm are more people-oriented, and other people are more risk-oriented, and I fall squarely in the center of those two things. And I mean, like, for me, I love the geek stuff. Clearly, I'm sitting on this panel. I mean, how do you know what to invest in if you don't build your own model? I mean, how do you know if something's going to work if you don't understand the underlying basics of what's going into either the multi-factor model, or the loans that are going into the CLO, or the CD. I mean, how do you know? So it's very important that you understand each of the underlying instruments, which is why I love the breadth that I get to pull in across my different managers, and understanding how each of those different markets work, and why each of them is shut down at the market right now. That's my spin for not getting into the markets today.
He said you were trying to hire
I
somebody
know.
out there.
So just out of curiosity, how many statistics courses did you take in your preparation? More than one?
I took none at the Stanford Graduate School of Business. I don't know, my math at Caltech was more about letters than numbers.
Ludwig, pick one of the many firms that you worked at and describe your favorite day.
My favorite day, okay. Well, first of all, I have to do a little plug here, you'll excuse me here, but on all this quantitative portfolio management stuff, I've written a book that you can buy on Amazon. I really say it's useful. It's not because, and the reason I wrote the book actually is because I wanted to buy the book and it didn't exist. So I said maybe I should write it. And that's a true story, that's how I wrote it. So anyway, you might want to, it's a good thing.
Are they for sale in the lobby?
They're not. I'm not that desperate. But you can buy it on Amazon. It's cheaper than going directly to the publisher. So it's called Quantitative Equity Portfolio Management. You can't miss it. So now, sorry, is that on tape? Now, going back to this question. First of all, I want to separate two things. There's, as you mentioned, Samantha, when you become a manager, your life becomes sort of different. So as a quant, you have the life after becoming a manager and the life before you're a manager, and those are different lives. You know, you have to deal with people. When I was so I'll talk about FolioFem. This was a company that I started, and we did a lot of quant stuff. We had a great team, amazing people, and I'll give you one project we did that was really cool. So what happened is we had to optimize all our portfolios using software that we had bought from another company, and we paid this company about, I think, $25,000 a year to license their software. And the software essentially did optimization of portfolios, any kind of optimization you want. It was a math company that provided the software tool. So we had a bit of a stagnant period where things were a little boring for some of the serious quants in our group. So I went to two of them and I said to them, hey, here's the deal, guys. Here's a book. And I threw this book on quadratic optimization on their desk. And I go, by the way, I did more work than this, but I like to make it relaxed here. So I threw the book on the desk and said, this book, somewhere in here, has everything we need from that software. Can you guys figure out how to adjust our programs to do everything that licensed software does so we save $25,000 a year? And they thought it was a really cool project. I didn't do it for the $25,000, if you want to know the truth. I did it because I thought they would like to do that project, okay? And we'd save $25,000 so I could justify it. So It took them about, I think, 2 weeks of messing around. And one day, one of the guys came in and said, "We've done it." And I go, "Let's see it." And so I went down and we ran the two programs side by side. Exact same results for the portfolio. So I knew that they'd got it right. We did a few tests, diagnostics, and we called the company and said, "We don't need your software anymore." We saved them $25,000, saved us $25,000, and they really enjoyed the project because it used quadratic optimization mathematics. It used programming. They programmed in Java. And so they used all these techniques that they'd learned, and they really liked it. And one of the quants, who I will never mention his name, but I don't think he liked me that much. And honestly, he loved this project. So it really worked out very well. So that was like a really, I thought it was an exciting 2 weeks getting that done. That's really good.
Steve, tell us how you use time series analysis in your day-to-day work.
I took Dr. Angus's time series analysis. It's really, really hard. And it's the only non-A I ever got at this school, so I'd like to thank Dr. Angus for that. A good day in my life means the portfolios are up relative to their benchmark. That's first and foremost. But, basically, as someone who oversees portfolios, my job is to make sure that the portfolios have the desired exposures that we want them to have. We want the portfolios to have certain characteristics, and each day we have to make sure that they adhere to those characteristics, whether it's certain alpha exposures or certain risk limits or risk budgeting issues or sector exposures, or whatever that may be. And if it's not, it involves trading and getting the portfolios where you want them to be. That part of the job is a fairly automated aspect of the job. It's in many respects on autopilot because we have computers, like we just described. We have quadratic optimizers to do that for us. And so that part becomes somewhat routine, although there's always something that creeps up, like the recent SEC order prohibiting short sales and financials. How do you deal with that? So there's always something in that regard with regard to implementing what we do. But perhaps what's more interesting is just the research aspect of it. This could be trying to come up with new alpha factors or new risk control measures. Just to give one interesting example of a project I did about 4 years ago, we were launching a global product, and we didn't have a global risk model. So what we did is we built our own, but we didn't know anything about global risk modeling. So what we did is some of you may be familiar with principal components analysis. So we took the covariance matrix of global returns and extracted the first 6 or 7 principal components from the data, and we used that to see if it was predictive of risk going forward, and in fact it worked pretty well. So things like that, that's just one example of numerous research projects I or other people have done over the years at Analytic. But what you'll find when you go to a quant firm is there's all kinds of roles for different kinds of people, and as you move up in the organization, you find you're dealing more with personnel issues and less so with research. But there's all kinds of roles in a quant firm, and there's different paths you can go depending on what sort of your strengths and weaknesses are.
Excuse me. So for being one who is not actually at a quant firm, because I work at Southern California Edison, which most might say, well, that's a pretty boring electric utility job. Well, for anybody who sits down with me for about 5 minutes or so, you'll quickly find out that it's not. Ask James. He's talked to me for the last 3 weeks about energy, and every day he goes away, he comes back with 5 times as many questions as he left with. So anyway, and as Ludwig was talking about this programming opportunity that I gave a couple of those folks, I don't manage anybody right now, which is kind of nice, because in my prior life, when I used to be this director of structure and pricing for retail electricity on the unregulated side, which is a whole nother fun experience. I just remembered I've got some programming I've got to do. So what I've got to do is essentially take a few of our programs, which are demand response programs, which basically means that we're telling people or asking people to turn electricity off. And I've got to translate that into what is otherwise wholesale electricity and capacity. So essentially that's what my day is like. And I get to play with code, which is great, because I get to run away and hide and just code for days and days and days, and sometimes months. As a matter of fact, I was talking to some of my former traders, there still are traders, but they weren't trading when I was trading. And I said, so you guys are supposed to be replacing my software by now, right? And he said, well, next year, we're hopeful that we can finally get rid of the temporary software you put in. That was only supposed to be a 3-month bridge, and it's been 7 years now. So, you know, the largest electricity utility in the state of California is being run on software that I created. It's pretty cool. And I get to keep doing more of it. But the quantitative part, and the reason I came back to CGU to get the FE degree was I had a bunch of regulatory politicians, or not politicians, but regulatory folks in our organization who were dealing with retail customers, trying to figure out how to make these programs that would allow us to reduce demand when we needed to rebalance the supply and demand curve, but they didn't know any quant. So lo and behold, I found myself in a position to step right in and say, this is cool, I'll deal with that part of it. So I came back here to give myself a little more of an academic perspective, because in the demand response space, nobody knows what the hell is going on. And I use that word specifically, nobody knows what the hell is going on. As a professor, I really admire, likes to use occasionally strong words to get a point. It's important to recognize when there is no answer, not only in the back of the book, but anywhere on the horizon. So now in the state of California, I have found that I am the one guy for the 3 utilities in California, Pacific Gas and Electric Company, Southern California Edison Company, and San Diego Gas and Electric, who understands the confluence of how people not using electricity makes cents and dollars in wholesale power. It's kind of cool. It's very quant, but it's not anything anybody else is doing.
The recent financial crisis reminds me that financial engineers, or quants, and related complex products such as hedge funds, options, and other derivatives are often blamed for the extreme turns that we experience in the market. I'd like to ask the panel to please clarify the role of the financial engineer in your business, and tell us whether you think the current market conditions signal the need for fewer or more well-trained financial engineers. Let's start with you, Vic, on this one.
I'm a little bit biased here, but I certainly think it probably needs more people that understand these things, especially.
Preach to the choir.
And they're not laughing. Okay, but so they don't believe me. I certainly think more people should understand this stuff, especially executives who really have no clue what's going on. Neither do the 2 presidential candidates who are running right now. And they should probably know a little bit even at their level. So that's one thing. I don't like people to blame derivatives for this mess, and I'll give you one simple reason why. The simplest derivative, if you want to call it that caused this whole mess, was a loan that instead of being a fixed-rate 30-year mortgage, was a ARM or was a graduated payment mortgage where you pay a little now, a lot later. And that was, everyone can understand that. I mean, as long as you can add 2 and 2 and get close to 4, you can pretty much understand those differences. And it was that what really caused this housing bubble. And so then, sure, later people packaged up these mortgage backs, securitized them, sold them off. But the original problem was too many people were buying homes. That was the original problem. They couldn't afford them, I should say that. So, you know, I think, if anything, the derivatives, the CDOs, the mortgage backs facilitated these markets. Part of the reason that so many could buy a home was because Freddie and Fannie do the securitization of all these mortgages. And they have to use derivatives, and they have to understand derivatives. They have to hedge some of that risk, et cetera, et cetera. But again, the underlying problem was in the housing market, in the very simple relationships there. So I think, you know, not much more to say for me than that, but more people should understand it, and people should not blame derivatives. The only part where derivatives were they part of the link? Absolutely. In the sense that in the old days, if you go to 1980, I believe 85% of banks that made loans kept 85% of their loans in-house. Okay, so they knew the loans they were making. Today, I believe it's about 45%. And why? Because they could get those loans, package them up, sell them out the door. Okay, so now people, this bottle in today's world represents loans in Stockton, California, right? And it's complicated, but more people should understand it. I'll stop there.
I don't think it's by any means derivatives that cause this. Asset price bubbles have been around since the dawn of time, whether it's tulips or internet stocks, or most recently oil and mortgage-backed securities. I mean, bubbles are caused by human behavior, by herd mentality, and by hubris. The complexity of the instrument arguably could exacerbate the problem insofar as people may not truly understand what it is that they're leveraging 60 times on their balance sheet. But the inherent human need to chase performance and take excessive risk, particularly if they've been successful recently, that's just something that's in human nature. It's inevitable if you've had some success in life that you're going to attribute all of your success to your own skill as a human, and not to the fact that you've been somewhat lucky in certain aspects of your life. And as people become more successful, they discount the contribution of luck to their success, and they emphasize the contribution of their own skill and brilliance. And that can become a very dangerous combination. And the most recent crisis is a perfect example of that. And I'm also somewhat sympathetic to the CEOs whose companies have been taken down. Richard Fuld, the CEO of Lehman Brothers, testified in front of Congress just yesterday. And I actually felt sympathy for him. I actually truly believed when he said that he had no idea that the value of these mortgages would fall like they did. And a lot of that is behavioral. The liquidity in these markets has completely dried up. Efficient markets relies on the premise that there's a buyer who's willing to step in when the price gets low enough. But if there's no buyer there, if there's no liquidity, markets can completely break down. And in many respects, that's what we've seen now. So I don't think it's derivatives per se. I think it's human nature that causes problems.
I agree with much of what Steve had just talked about. The one interesting aspect of what derivatives have done, though, is they have allowed the efficiency of the market, or the efficiency of the transaction, especially the efficiency of one market influencing another market. I mean, as Steve brought up, the tulip crisis way back in the 1900s or 1800s didn't influence other markets. It didn't have an impact on anything else. Well, today, because financial engineering and the brilliance and the wisdom of being able to do cross-commodity transactions allows what I was sharing with a gentleman earlier. I mean, when I used to trade electricity in the old days, electricity was the new beast on the block, and oil traders were trading around 12 vol, or 12% volatility. Natural gas traders, they were on the high end, and they were trading between 60 and 80% volatility. And electricity traders, after I stopped trading, I started talking to them, and the electricity market got so crazy, it was trading at 300 vol. Well, anytime it would drop less than 200% volatility, they would stop trading. That would make an oil person go berserk, because they were used to trading 12 vol, and in a 200 vol market, they thought that was cool. Well, the fortunate thing about financial products is oil now is seeing vols that they have never seen before. So the crossover from electricity vol is driving all the way through natural gas to oil and influencing that. So the convergence of all these commodities, or the convergence of all these financial positions you can take, is almost seamless. It's almost mathematical in the fact that you can go from degrees to radians to whatever you want. You can translate one element to the other, like I'm translating demand response into wholesale power. I mean, financial products are allowing us to do that, and at a very effective rate.
I think that, yes, we need more financial engineers. We also need more people that are smart, that understand math, and that know what they're buying before they buy it. So my comment about derivatives is that they're completely useful. We need them in the market. You have to be able to hedge effectively across all of the instruments that you're purchasing. And have to have the smartness to know how those instruments are affected by the underlying, what the derivative is on, and have to be able to recognize how they work together in your portfolio. So risk management, I think, is just as important as sort of purchasing individual capabilities.
Thank you. That reminds me of a question that I hope we would get to, and I'm going to ask it now to make sure that we do get to it. During the current financial crisis of the past 2 weeks, short selling of financial stocks was temporarily restricted in the U.S. and the U.K. The ability to hold long and short positions in assets is key in the practice of option pricing as well as the day-to-day management of portfolios. So the first person to take this question, please tell the audience, some of the audience may not be FEs, but tell us what short selling is, and then discuss the implications of these restrictions for option pricing and or your day-to-day activities on your job. And I think we start with Steve on this one.
Sure. Short selling is the practice whereby you don't own a security, but you think it's going to go down in price, presumably, and you can go to a bank where someone holds those shares in an account and you can borrow those shares from that person or that institution. So you've now borrowed, say, 100 shares of IBM, and then you can go out to the open market and you can sell those shares that you don't own. So now you have say, $100 in cash, the shares of IBM that you sold, but you owe 100 shares to this person that you borrowed it from. What you hope is that you can go back in the future and you can buy those shares back at a lower price. You can give the person who you borrowed those shares from their shares back, and then you have a profit. That's a very simplified reason why you would short securities. In our business, we don't really short securities because we think they're actually going to go down. We short securities because we think they're going to go up less than the stocks that are long. So you'll read in the media all the time that people short stocks because they think they're going down. That's usually not why people short stocks. In terms of the regulation, this recent SEC regulation, how it's affected us, it's had a material effect on our business. If you can't short, it makes running hedge strategies very, very difficult. Originally, when the SEC first announced this rule, I think it was mid-September when they first came out, it was over about 600 or 700 financial stocks, which immediately caused problems for us because if we can't short financials, that's 20% of the S&P 500 that's effectively off limits to us. So effectively, what's happened with this SEC order is it's made a one-way door on shorting. So if you're currently short, like right now, we have a lot of short financials on our books, and we close that down, we can't initiate a new one. So it's actually a very tricky thing to model from a transactions cost perspective. You have infinite one-way transactions costs, and you can't open up new exposure, but you have minuscule transactions costs the other way. So from a modeling perspective, it's hard to handle that. Long story short, the SEC just extended it another 10 days, so now I think it ends around October 15th. We can deal with it if it's only a month-long thing, but if this is going to be a permanent thing, it's going to cause real disruptions to the market, real disruptions for what we do.
Well, and interestingly enough, this response of making or restricting short sales is a lot like what happened in the late or early 90s. I can't remember now. When program trading was the perceived devil, because all these computer programs could trade much faster than people could, and so all of a sudden you'd start to see these bigger swings in the marketplace. So they initiated a rule, and it's still in place, I think, where they can install it. Or actually, maybe it's not now. I don't know, because you'd think they would have put curbs in at some point in time today or a week ago. I know curbs are still in, but why wouldn't they have put them in when we had the 800 drop yesterday? I just don't know. At any rate, so you know, occasionally we do get these non-mathematical or uneconomic responses to what we would otherwise see as a typical response to the market. I mean, for instance, it's not just hedge funds or financial houses that would be interested in shorting a company. When we contract with a counterparty, with a generator to provide us energy, one of the ways that we can protect our credit risk is to actually short the company. Because if they're unable to pay us, the value of their equity, certain equity position would fall, and so we would be able to make money on the equity position that we held, which was a negative equity position, which would reduce our accounts receivable risk. So fundamentally, the notion of limiting short sales is one of those artificial things which in the regulated world, I continuously deal with. So the notion of being able to do a transaction one way but not another way isn't an unusual or unexpected thing in my world. But clearly, it's as I like to say, it's a confluence or the transition from an economic market to a regulatory market, and sometimes that seam issue can be really hard to deal with. It's kind of like an asymptote that pops up in your otherwise perfectly nice formula.
Yeah, so I think this is one of those cases where you have to know exactly what you're dealing with. So not only is there a short sale ban in the U.S. that has been added to every day by new tickers, there's also in the UK, Australia, Korea, Taiwan. So this isn't just something that's happening here in big developed markets. So this affects, for me, the long-short Asian manager that I cover. They had a decent gross exposure to Australian banking shorts that they have kept on through this time. It has affected the ability to short and do stock swaps in the Korean markets. It's sort of all over the place. I have a manager that is long-short equity financials only, and we get position level transparency. So being able to match the tickers that I get in that file to the ticker list that comes out, from our Morgan Stanley prime brokerage, whatever client service person every day, I knew exactly what stocks would be affected in their file. And the day that the rule came out, I called them and said, "Where did we do that?" So it all kind of confluences together. I would say also that it's not just about what stuff you can or cannot short. There's also the SEC rules that go along with it. So having to disclose your shorts is big, and managers may or may not want to do that. But you sort of have to understand how everything gets put together before you can criticize one specific thing.
I'm just going to be quick. Rather than comment on that, everyone's done it. This is where quant comes in as well, because suppose you're at one of these firms where you're an individual investor, you need to start thinking about, suppose I want to short, or I want exposure to the short financials, what do I do? So you can use quantitative techniques to figure out what kind of stocks are seemingly financial stocks. GM, for example, they have a huge portfolio of loans. So you can start looking at and using quantitative techniques, statistics, econometrics, to try to figure out what stocks actually behave like financial stocks, and I'll short those. So that's one kind of creative idea. You could also do a basket swap with some investment bank where they pay you the short of a financial basket and you pay them LIBOR. So you could do something like that. Like the day after we had the short restriction here, Goldman Sachs was offering that to customers. Then they got rid of it once the UK banned shorting, because that's how they were hedging it. The other thing you can think about doing is, for your own portfolio, is using ETFs. There still are financial ETFs which are short. I worked at one of those companies, and we created these things. So you buy the ETF, and it's short financials. They also are under the same restriction to not short financials, but they can still sell you. You can basically buy these ETFs from other people who own the units. So be careful doing it, because there is a discount. You're paying a premium for that ability, but you can still do it. So in fact, today I think it was down 11, 12%. If you had bought that thing, you would have been up 12%. Sorry, you would have been up 12%. And you can look at other things, consumer staples. So it creates a lot of creativity in these moments. You can try to do.
I think a good follow-on to that is In view of the current market conditions, what training and skill sets will be key for financial engineers to be successful in the job market as the financial markets move forward to the next 5 years? And what areas do you see as having the most growth potential? Would it be risk management, would it be asset management, or others? Back to you.
Well, for the traditionalists out there, I don't know if you really want to hear my answer, but I think I think essentially a well-rounded financial engineering or financial math basics is really key to going anywhere. Because as we've essentially said, the more, as I was saying earlier, the ability for financial engineering has caused what had otherwise been seen as barriers or boundaries have been eviscerated. And so essentially anybody who's doing a transaction in the marketplace, even if they're just simply trying to contract for feedstock going into whatever they're going to produce, or they're trying to contract on the output of their production, they're going to need to have some people who understand what financial engineering is all about so they can figure out how to manage that transaction from a financial exposure perspective. So essentially, financial engineering right now is a real good launch pad to just go about anywhere. You don't even have to go as far as I've gone, which is to go way out into the ether world and try to figure out what somebody's behavior, turning on or off the light switch, how much money that's worth.
I guess I think that risk management is key for the next 5 years. I think being closer to where the money is, no matter what time or place or what the markets are doing, is always key. So sort of working for a state pension plan is never going to go away. Working for a corporate pension plan is never going to go away. Working for a large retail mutual fund house is never going to go away. These are very stable kinds of asset management jobs that you will find time and time again. What I look for in people that we hire that have sort of a financial engineering background, I look for people that are smart, I look for people that are creative, I look for people that love finance and are eager to know what the market's doing and why it's doing it. And I think those sort of qualities work in a variety of different places, from Vara to a hedge fund to a pension plan, sort of going.
Yeah, similar things here. First of all, statistics. I can't tell you enough how much statistics to take. Take statistics, take mathematics, take programming, basically the hard stuff. That's the reality. It's good to know accounting and corporate finance because those are really good. Because what you also get, in this, when there was a migration of these physicists and mathematicians to Wall Street, you got all these guys who I remember one time there was this guy, I won't do his accent, it's hilarious, but I can't do it here, it's on TV. He was a good friend of mine, by the way, but what he did is he was an engineer. His background was mechanical engineering. So he came up with this amazing model to do portfolio allocation. And he used this thing called fuzzy logic. And he came out and he said, "This is the best paper in the world." Right? So we took down the paper into its core components, and it turned out to be mean variance. So the problem sometimes you get with people who don't have enough finance is they're really great at doing fuzzy logic and nearest neighbor stuff, but when you boil it down, it doesn't do anything. So know the finance. You need the accounting. Accounting is really important. Another thing, I dislike accounting, but very important, corporate finance. What I look for when in the area, credit default, also if you can do a specific area, anything credit derivatives will be helpful, because all that math is, and the math behind it's very, very good too. So just know that stuff. Programming too, try to program. Just do it for fun. Start writing a program on your laptop out at the cafes on the weekend to do something like a Monte Carlo simulation. It sounds not so fun. It's actually pretty fun. Okay. And then what do I look for? And I think other people do, but for me personally, when I was hiring people, I look first for motivation. You've got to be motivated. If you're not someone who's excited, if you're not someone who, when I say, did you see the betting market today on Obama and McCain? And I wonder if there's some arbitrage. If you're not the type of person who that night will actually figure it out and come to me in the morning and tell me what you figured out, that's not motivated enough. You need to be that motivated. Intelligence, you've got to be intelligent, and that varies. You know, there's so much you can do about that. But you can certainly, well, it's true, right? But you can certainly work harder. And I've met a lot of people who may not be the smartest guys, and I include myself in that, but worked hard to gain where they were losing on the natural intelligence, or whatever you want to call it. And finally is personality. Personality does make a difference, and you'll find that basically what happens is if you have a personality that works with the guy who's hiring you, you're going to get hired. It's sort of that. So I can't give you general advice because the guy who's hiring you could have different personality. I'll tell you one story about a guy that I hired, and I want to tell this story. One of them, I went all the way to Harvard to hire. I actually went to Harvard to their PhD program and met, I had a friend who was a professor there and said, I want to know your best candidates. And I interviewed all of them at a cafe, and lucky enough, one of them came over, and by the way, he's the co-author with me on the book, Day One Kim. So, turned out to be a great colleague, a future co-author, never knew it, but that's how I got him. Another guy I had, and it's the last little story, but he came in from a school, and I shouldn't say this, but it's true. I screen by schools too. And it's true, everyone does it, so it's a reality. So this was a school that I thought, should we really hire? I'm just being frank with you, because people think this way. And the HR lady actually convinced me, you should look at this guy. So I said, let's give it a shot, bring him in. Guy comes in, and I gave him my standard 8 quant question interview questions. And on one of them in particular, he bombed on it. He just could not get the answer, okay? And he said, tell me the answer, and I go, well, think about it. That night, I got an email from him, and here's what it had in the email. I thought about it, and I'm sorry that I didn't know the answer. I was a little flustered in the interview. But here's what you really wanted the answer to be. And he wrote down this answer, and he said, furthermore, I wrote a program using real, actual data. Here's the program and the data. And it computes what you wanted me to compute for all the S&P 500 stocks. And it was there, and it worked, and the program worked. He got the job the next day. So what he did is he showed his intelligence, his motivation, and he did have a good personality. So that's all I got to say.
I'll just be really brief. I mean, I concur with everything Ludwig said. I mean, you know, at a base level, you have to have a decent amount of math. You have to have statistics. You have to be able to program. You have to know econometrics. You have to be able to think logically and probabilistically. But those things are, in the language of mathematics, a necessary but not sufficient condition to be successful in this industry. I mean, you've got to have a good personality. You've got to, ultimately the people who are the most successful in this industry are those who have good personalities, can communicate with people, and have those tools that I just mentioned. Those are the people who are ultimately the most successful. And lastly, the thing that I think is really, really critical, and it's probably one of the hardest things to find, I think a couple of the panelists have mentioned it, is creativity. You know, in my experience, the people who, and I don't mean this in a negative way, but I talk to a lot of people out of FE programs, and they all have great quant skills, they all have great technical skills, but they don't seem to have that creativity and intuition. And you go to the MBA schools and you find just the opposite. You find they've got the intuition, they've got the drive, but they don't even come close to having the quant skills. So if you can find a blend of those two traits, I think you really would have what it takes to be successful in this industry.
I'm biased, but I think our program has both of those components. I mean, it is split in the middle between math and management, right? So I'm going to ask one more question of the panel, and then open this up for questions from the audience. As the saying goes, money is always there. The pockets just change. So would a financial engineer do well to consider working in foreign offices or markets where unique opportunities might exist? And if so, where do you think those opportunities are?
Oh, I totally think you should go work overseas. I worked in London for a year and loved it. Oh my gosh. I grew up in the Valley in Burbank, and then, I went to Pasadena for college. Totally opened my eyes. Oh my gosh. I've never lived overseas. So it was fantastic. And at Camco, we have an office in Irvine, we have an office in London, and we have an office in Singapore. So maybe the money is shifting pockets around the world, but the U.S. probably still has the biggest pocket. Just said it's empty right now. I don't know. What was the other part of the question? I just think, of course, you should go.
Where are the opportunities?
Yeah, I mean, they're everywhere. You just have to open your eyes, right? You can go and work at a power company. You can work at a risk management company. You can work at a pension company. Just be creative.
Yes, certainly. You know, the way I look at it, I had one of my best friends in grad school. He was half Japanese and half American, and he got a job he had a great skill, though. And so I'd really say, particularly for people who have dual languages, consider going to other countries. He spoke Japanese fluently, and he spoke English fluently. So he got a job offer from Salomon Brothers, which doesn't exist anymore. It was bought by, no, it didn't go bankrupt. It was bought by Deutsche, who bought, I don't even remember. Citi bought Salomon. So he went there and he got a job in trading in Tokyo. And after that, it was even higher. He was out, just a quick addition. Rudy Dornbush used to say, famous international economist, used to say, you'll always end up where you should be. So what he meant by that, I think, is that whether it's luck or not, I think the biggest thing I would go for in my quant, for whatever you're going to do, just love what you're doing. And it's a cliche, but the reason is because in 10 years, it could turn out you're with the right people. One of the things about luck is it's not just luck to you, it's that the lucky that you're with a team that helps you get to the right place. You know, if you landed at, KKR 20 years ago, you probably could have been not very good and you would have made it, right? So I think it's mainly love what you do and have fun with it. And that way, 10 years later, if you don't like it, if it doesn't turn out to be very successful, you're still happy. And if it turns out to be successful, well, you get to have the ranch in Idaho.
And if you do become successful, don't be